Have you noticed how the price of almost everything seems higher than it was a few years ago? Food, rent, electricity, cinema tickets, over time they all creep up. This is not just bad luck. It's a normal process in the economy called inflation. Inflation means that prices go up and as a result, each unit of money buys less than it used to. In this video, I'll explain two big things in a very simple language. First, what inflation really is and how it quietly eats the value of your money. Second, what people often do about it, the main strategies they use when they want their money to try to grow faster than prices rise. We'll talk about keeping some money as cash and lending money to governments, owning tiny pieces of real businesses, putting money into big baskets of investments managed by professionals, owning a property like a flat or a house. And third, I'll share a quick process that helps us avoid mistakes. I'll explain every word as we go. You do not need any background in finance. Imagine you're starting from zero. That is exactly who this video is for. So, let's make inflation very clear. Inflation is the name for a situation where prices of many everyday things go up over time. When that happens, the same amount of money buys fewer things than before. Your money loses buying power. Imagine a simple shopping basket. Bread, milk, some vegetables, bus tickets and a phone bill. Suppose today this basket costs 100 units of money. If inflation is 3%, then on average next year the same basket might cost about 103. In a few more years it might cost 110 or 120. The exact numbers move around, but the direction is upwards. Governments and central banks track this by watching the prices of hundreds of items and combining them into a single number, often called a price index. They then say things like inflation this year was 2% or 5%. In many developed countries, the people who manage the money system actually aim for a small level of inflation, of around 2% per year. They believe this small, steady increase in prices is a sign of growing, healthy economy, not too slow and not too fast. Now think about your savings. Suppose inflation is 3% per year on average. That means prices are rising about 3% per year. Imagine you have 1000 units of money in a simple bank account that pays almost no interest, maybe 0.5% or 1% per year. The number in your account will grow a little, but prices outside of the bank are growing faster than your money. So even though the balance in your account is going up a bit, what you can actually buy with that money is going down. Over 10 or 20 years, this can make a very big difference. Inflation is like a slow leak. You don't see it happening day by day, but it keeps going. That is why many people do not rely only on cash if they want to protect their future buying power. They look for tools that give their money a chance to grow faster than the prices over the long term. There is never a guarantee, but there are ways to try to give yourself better odds. Because of this slow leak from inflation, people use different tools to try to protect and grow their money. Let's walk through the main ones. Keeping some cash and lending it to governments, owning tiny pieces of companies, joining big baskets managed by professionals, and buying a property like homes or flats. We'll go through each of these slowly and simply. First, let's talk about the safest feeling corner of many people's money: cash and lending money to governments. Keeping some cash in a simple bank account is important. This is your emergency money, the amount you might need in the next 3 to 6 months for surprise bills, car repairs, or a sudden loss of income. Here, the goal is safety and quick access, not high growth. When a government needs money to build roads, hospitals, or schools, it can ask people and companies to lend it money. It does it through something called a government bond. Here is the simple idea. You give the government a certain amount of money, for example 1000 units. In return, the government promises two things. It will pay you a fixed amount every year as a thank you for the loan. You can think of this like a rent on your money. After a set number of years, maybe 3, 5, 10 or even 30 years, it will give you back the original 1000 units. These regular payments are called interest, because many people trust their own national government to pay its debts. Loans to governments are usually seen as a lower risk investment compared to many others. But lower risk normally also means lower potential reward. Over long periods, collections of these loans have often given returns in the rough range of 4 to 6% per year in most of the markets. Those figures come from history, not from a promise about the future. Markets change, interest rates change, and bond prices can move up and down. Some governments also offer special versions of these loans, where what they pay you moves with inflation. These are designed so that what you receive better keeps pace with the rising prices, plus a small extra amount. They can help you with inflation, but they still have their own risks and may not be available or suitable for everyone. Let's look at a simple real-life situation. Imagine this is Vala, who has just moved to a new city and wants a safe cushion while she settles into her job. She keeps 3 to 6 months of expenses in a simple bank account, so she can handle sudden costs without stress. On top of that, she buys a small amount of short-term government bonds through her bank's investment platform. She knows they can still move up and down, but she likes that they are generally more stable than many other investment alternatives and that she receives interest on top. That combination gives her quick access to some money and a slightly higher earning, but still relatively cautious layer on top. Cash in the bank is easy to reach and simple to understand. The amount you see does not jump up and down every day. It's very useful for short-term needs and emergencies. But the downside is that if inflation is higher than the interest you receive, your money quietly loses buying power over time. For long-term goals, relying only on cash usually means your future self can buy less, not more. Government bonds are generally seen as a lower risk than many other investments. They pay regular interest, and inflation-linked versions are built to help protect buying power against rising prices. Their downside is that lower risk does not mean no risk. If you need to sell a bond before its end date, the price might be lower than what you paid, and you could lose money. In very rare cases, the country is at war or occupied, for example. The government can even fail to pay back fully. And over long periods, bonds usually offer lower potential growth than owning pieces of many companies. Now let's look at owning pieces of real businesses. When a company is created, its ownership is split into many pieces called shares or stocks. If you buy one share, you own a very small part of that company. Imagine a pizza cut into 1000 slices. Each slice is one share. If the pizza gets bigger and more valuable, each slice is worth more. In the same way, if a company grows and becomes more valuable, each share can also become more valuable. You can benefit in two main ways. If the share price goes up and you sell your share for more than you paid, you make profit. Some companies also pay part of their profits to shareholders as cash payments called dividends. Looking at large groups of big companies over many decades, broad markets like the 500 largest listed companies in the United States have on average grown investors' money at something like a high single-digit percentage per year after the inflation. That's why shares are often seen as one of the most powerful tools for long-term growth. That's a story from the past, not a guarantee for the future. Markets can go through long, painful periods, and individual companies can do very badly or disappear. When you invest in shares, your money is always at risk. At Value Sages, we believe that owning pieces of real businesses can be a very good thing, but only when you know what you own and why you own it. That means understanding how the company makes money, whether it has a strong balance sheet and what price you're paying compared to its profits or cash flow. Good information and careful analysis can't remove risk, but they can help you avoid obvious mistakes. Think about George, an investor who loves technology. Instead of guessing and buying whatever is trending on social media, he reads basic company information and uses tools like value stages to see how profitable a business has been and how much debt it carries. He may still decide to buy only a small amount of one or two companies he understands well, while keeping most of his long-term money in broader baskets we'll talk about next. He accepts that these individual shares can be more volatile, but he has reasons for owning them. Individual stocks can offer relatively high potential growth if you choose strong companies and hold them for many years. You can focus on businesses you personally understand and believe in. Their downside is that they are high risk. If you choose badly, you can lose a lot or even all of the money you put into a single company. Prices can jump up and down daily, which can also be stressful. Because choosing individual companies can be difficult, many people prefer to join together with others and let professionals manage a basket for them. This is where mutual funds came in. A mutual fund is a large shared basket of investments. Many people put their money into this basket. A professional team then uses this pool of money to buy many different things. For example, many company shares, loans to governments, or a mixture. When you invest in a mutual fund, you own a small slice of that basket. You do not pick each company or loan yourself. If the things inside the basket go up in value, your slice increases in value. If they fall, your slice falls too. Some mutual funds simply try to copy a group of investments, often called an index. Others try to do better than that group by choosing what they believe are the best ideas. Over time, mutual funds that focus on company shares often have results similar to the group of companies they follow. So, if a fund tracks a broad group of large companies, its long-term return might be in the same general range as the market. Historically, around 7 to 10% a year before inflation in some large markets. But again, these are long-term historical patterns, not promises. Different funds and different markets can behave very differently, and there will be good years and bad years. When you use a mutual fund, you pay ongoing fees every year. Part of these fees pay for the team that researches companies and manages the funds, plus the cost of running the fund itself. These fees are often taken out whether the fund has done well or badly. That means that in a good year, fees slightly reduce how much of the growth you keep. In a bad year, they make the loss a little deeper than the market's own fall. Over many years, even a difference of 1 percentage point in annual fees can add up to a big difference in your final outcome. Imagine this is Lala, who is 30, fairly new to investing, and saving for her retirement in 30 years. She doesn't want to choose individual companies. Instead, she picks a broad mutual fund that invests in many large companies across the world, and she sets up an automatic monthly payment into that fund. On good days and bad days, the same amount of money goes in. For her, the fund is a simple way to stay invested without having to watch the markets every week. She knows there will be down years, but she's focusing on the next 3 decades, not the next 3 months. With one mutual fund, your money is spread across many investments at once, which can reduce the impact of any single company doing badly. A professional team monitors the investments for you, which is easier than doing all the research on your own. A mutual fund can make it easy to set up regular monthly investing. Their downside is that you usually can only buy or sell at the end of day price, not at any moment during the day. Mutual funds charge ongoing fees to pay for management and running costs, and those fees are taken regardless of the performance. And because they hold shares or bonds, their value can still move up and down with the markets. There are no guarantees. An exchange-traded fund, or ETF, is another type of basket of investments. Like a mutual fund, it can hold many company shares, loans to governments, or other assets. When you invest in an ETF, you again own a small slice of that basket. The big difference is how you buy and sell it. An ETF is bought and sold on a stock exchange, the same place where individual company shares are traded. That means you can buy or sell ETF units during the trading day, and the price changes as people trade. Many ETFs are designed simply to follow a specific list of investments. For example, a group of watch companies in one country, a group of companies worldwide, or a group of government bonds. Because many ETFs just try to copy these lists and not outsmart them, they can often be run at a relatively low cost. An ETF that follows a broad stock or bond market will usually end up quite close to that market's performance, minus its fees and trading costs. That can be a very efficient way to get something close to the average results of a whole market. But that average result can involve big ups and downs along the way. An ETF can drop sharply in a market crash, just like the underlying shares or bonds it holds. The fact that ETFs trade like shares is both a strength and a danger. Being able to buy and sell quickly can tempt people to trade them like a short-term game, jumping in and out on headlines. Frequent trading can rack up costs and often leads to buying high when things feel exciting and selling low when things feel scary. Think of George, who wants a simple, transparent core for his long-term portfolio. Even though he has years of experience picking individual shares, he chooses one ETF that follows a broad global stock index and one ETF that follows high-quality government bonds. Once a month, he puts a fixed amount into both. He isn't trying to guess the best day to buy. He just wants to steadily build ownership of a wide slice of the world economy over many years. With one ETF, you can spread your money across many investments at once. You can buy and sell during the day at market prices, which offers flexibility. Many ETFs have low ongoing fees, which helps more of the eventual growth stay with you over many years. Their downside is that, because they are really easy to trade, some people end up buying and selling too often, which can hurt their result and create extra costs. You may also pay trading fees depending on your provider. And like any basket that holds shares or bonds, an ETF can drop in value in a bad market periods. Finally, let's talk about owning property directly. For example, an apartment, a house, or a small shop. When you own a property, you can benefit in two main ways. First, if you rent it out, tenants pay you money each month. This rental income can help cover your costs and over time can become a source of profit. Second, the property itself can change in value. Over long periods, in many countries, property prices, especially in growing cities and attractive areas, have tended to rise, sometimes somewhat faster than the general inflation. Research that looks at housing over periods suggests that when you combine rent and price change, owning residential property has given mid-single-digit returns per year, above inflation in many markets. But property markets are local. One city can boom while another stagnates or falls. Repairs, taxes, interest rates can all eat into the return that looks attractive on paper. Consider George and Desislava, a couple in their mid-30s. George has been investing for years and enjoying analyzing numbers. Desislava is newer to investing and is mainly focused on their home and day-to-day stability. They buy a small flat to live in using a mortgage. For them, the main goal is a stable home. If the value rises over the years, that's a bonus. Later, when their income is higher, they might decide to buy a second small flat to rent out. They carefully calculate the rent they can realistically charge, subtract the mortgage payment, property tax, expected repairs, and periods with no tenant. Only if the numbers still look sensible to both of them do they move ahead. They accept that the flat can lose value in a downturn and that they have to deal with broken boilers and late rent. When property prices fall, it can be very hard to get out quickly. You might be forced to sell during a bad market and walk in a loss. And if you use the word loan, a fall in property value does not reduce the debt. You still own the same amount to the bank. Property is something you can see and touch. Rents and property prices often rise when prices in general rise. So property is often seen as a way to help protect against inflation. If you rent it out, it can provide regular income that can support your budget or help pay off any loan used to buy the property. A downside is that buying a property usually needs a larger amount of money and often a loan, which adds risk if your income changes. It is hard to sell quickly. Selling can take months and involve fees, taxes, and paperwork. You are responsible for maintenance, repairs, insurance, and dealing with tenants, which costs time and money. Property can also fall in value, especially in weak local markets. Let's briefly summarize the main ideas from this lesson. We started by seeing that inflation is when many prices rise over time, so the same amount of money buys fewer things. That's why it helps to think not just about your balance, but about what it can buy in everyday life over the years. From there, we walked through the main tools people actually use in practice: cash and government bonds, individual company shares, mutual funds and ETFs, and for some people, properties, each with its own mix of potential return, risk, costs, and effort to understand. We saw that the time horizon and personal situation matter a lot. Money that might be needed soon is often kept in safer, easy access places, while long-term goals more often use broader baskets of investments like funds or ETFs. And through the examples of George and Desislava, we saw how people combine these ideas in real life. Keeping a cash cushion for emergencies, using relatively cautious investments like high-quality bonds, and adding some exposure to businesses or property, not to build a perfect one, but to create a mix they understand and can live with through the both good and bad periods. At Value Stages, we describe a simple process to help avoid some of the most common mistakes. We call it the S.A.G.E framework. Screen the noise in the market, analyze the fundamentals of a business, govern your portfolio with clear rules instead of emotion, and evolve your wisdom over time as you keep learning. This kind of structured approach cannot guarantee results, but it can help you stay focused on data, discipline, and learning rather than headlines and hype. The S.A.G.E framework is the backbone of how we build tools and education. You'll see it again in our other videos and on our website if you want to go deeper. To sum up, inflation can reduce the buying power of money that stays in cash for long periods. There is no magic solution that always beats it, but understanding these tools, using a clear process, and being patient can give your future self more options, not fewer. Just remember, this video is only a starting point. It cannot take into account your full personal situation, your goals, or your local rules. Use it to ask better questions, to read more, and, if you need it, to have a smarter conversation with a regulated advisor in your country. Thank you for watching, and remember, the earlier you start learning and taking careful, small steps, the more time your money has the potential to work for you.